So the 1990s economy is largely driven by two things. Obviously, the computer and internet, but also by the phenomenon of globalization. So what we mean by globalization is the idea that instead of having separate economies for each nation state, that we are increasingly moving towards one integrated, truly global economy. And that is definitely involved in information with a computer and the internet, but we also see that increasingly in products as well, that nationwide boundary lines increasingly are more fluid when it comes to trade. And we can see that in the US with NAFTA. So NAFTA, the North American Free Trade Association, is an alliance between the United States, Canada, and Mexico, which was formed in 1993. Initially, NAFTA was supported by George H.W. Bush, but it's also supported once Clinton takes over office in early 1993, and Clinton urges Congress to approve the NAFTA treaty. NAFTA took a page from the playbook of the European Union, which had existed in some form since the 1950s, and basically made it easier to trade across borders of the member nations. So the idea with NAFTA would be that it would be far easier to trade goods across the borders of the United States, Canada, and Mexico. However, NAFTA had some unintended consequences, particularly for manufacturing in the border region in which I live, El Paso, but it also has never really functioned as well as the European Union, and talks to expand NAFTA to include other nations in Central America and have never really gone anywhere either. What NAFTA did was it pushed some American companies to shift manufacturing into Mexico, where wages were lower and environmental regulations were less strict, so they could save money compared to locating their factories in the United States. And indeed, that did happen quite rapidly. And this, as I mentioned, does create more economic problems to for the United States because, again, manufacturing, which has already been rapidly losing market share and losing workers, is increasingly more Americans are losing their jobs in the manufacturing sector because of NAFTA. The stock market in the 1990s looks very similar to the one in the 1920s, which should set off some alarm bells in your head. Americans are investing in the stock market at levels unprecedented since the 1920s, especially in internet based companies, or what we call .coms. Okay. So people are investing in these new internet based companies, like, for example, Amazon, which in the 1990s gets its start selling books out of Seattle. By 2000, the majority of Americans had some investment in the stock market, primarily through retirement accounts, but there are also some Americans who are directly trading in hopes to make a profit in the stock market. The NASDAQ, which is the area of the stock exchange primarily devoted to tech companies, rose by 500% between 1998 and 1999 alone on the enthusiasm for these new internet-based companies. However, most of these internet companies were overvalued, as very few of them were profitable during the late 1990s. It took a while for companies, even like Amazon, which is huge today, to turn a profit. The stock market bubble will burst on April 14th, 2000, dropping stocks by the biggest margin in a single day in its history. Stock prices declined for the next 3 years straight, severely damaging many Americans' investments and retirement funds, which is why a lot of the older wave of the baby boom generation has been putting off retirement as long as possible, partly due to this first economic hit from the stock market bubble bursting in 2000. So the American economy then goes into a full-blown recession in the year 2001. Part of what's also driving this bubble bursting is in 1999, part of the Glass-Steagall Act, which had passed during the Great Depression, was repealed. So the part of the Glass-Steagall Act that was removed was the requirement that commercial and investment banks be kept separate. Now, originally, that rule was put in place during the New Deal to protect consumer uh, bank accounts from being used improperly by banks for investment and trying to protect consumer accounts from the higher risk of investment banks. Now, however, these are intertwined again. This will lead to shady and risky investment practices in the stock market by banks who knew that the part of the Glass-Steagall Act that still was in place would guarantee consumer account money, and banks had essentially become too big to fail. That if the stock market crashed, as it did, that the government would be forced to bail out these banks to save everyday American accounts. Many of these risky investments were not only in the stock market, but also in mortgages, and that will lead to another collapse in the housing market in 2007, which George W. Bush and Barack Obama end up having to spend billions of dollars to bail out. Now, in addition to this overly optimistic and risky investment practices, we also do have some corporate corruption going on, as many industries had been deregulated during the late 70s, the 80s, the early 90s, and that left them vulnerable to misconduct due to lack of oversight. Many companies in the late 90s started to make money by cooking the books. So they would portray their finances as positive when in reality they had a lot of debts. So basically, accounting firms and law firms are helping these businesses misrepresent their actual finances. These shady practices in the 1990s end up coming to light after the 2000 crash, leading many prosecutions of corrupt executives and repayments to consumers by companies who had fleeced them. And the biggest example of this corporate corruption was Enron. Enron was based in Houston, and it was an energy company, but it didn't produce energy. Enron basically bought and sold electricity. And so, because it didn't actually produce the electricity, it was not technically a utility company and could not be regulated in the way that a normal utility company was. Enron reported billions of dollars in profits that were actually billions of dollars in losses. And when this came out after the 2000 crash, Enron executives were arrested and convicted of fraud. Now, what does this mean for the average American? The 1990s did start to benefit Americans across all social classes. Remember, we talked about the 1980s being a time of great prosperity for the upper class, but not so much for the classes below them. But by the time we get to the 1990s, for the first time, real wages, or the purchasing power of the money you earn, actually begin to rise for all social classes. And this includes the working class, who largely had seen their real wage or their purchasing power decline throughout the 1980s. However, that rise is not even when we look at different social classes. The lowest skilled workers saw the slowest gains when it came to buying power. And when you adjust for inflation, the lowest skilled workers actually ended up barely having a different purchasing power with their money earned than their counterparts in the early 1970s. So, in other words, the working class had recovered from the 70s crash, but they weren't exceeding the early 1970s pre-crash yet. Long-term unemployment declined by more than 50% as the economy was doing well. And when we average out the late 1970s to the late 1990s, the lower middle class actually declined on average, while the upper class rose. So even though Americans were starting to do better than they had in the 1980s, they're still not doing as well as they had been doing in the early 70s. So the average person in the lower class saw a 12% drop in income between the 1970s and the 1990s. The middle class, only a 3% drop, so effectively they remain the same. The upper class, however, saw a 38% increase in their income between the 1970s and the 1990s. And in the 1990s, the richest living American was Bill Gates, who owned as much wealth as the bottom 40% of all Americans combined. So, why is this? Why is it that the wealthy are making so many gains in employment, but the lower and middle class are either staying steady or declining a bit? Part of this is a shift in the nature of our economy. As we mentioned, manufacturing jobs are increasingly vanishing. And so people are now moving towards a service, information, and finance driven economy. By the year 2000, the financial sector will account for 40% of the American economy. But even within the service and information industry, some of those jobs are being sourced overseas to take advantage of cheaper labor, which will lower prices on some goods and services, but also have a negative impact on American workers by making those jobs less available to them. So, the biggest employer of Americans in the year 2000 is Walmart. General Electric, or GE, had been the biggest employer of Americans for a long time, but in 2000, Walmart leapfrogs them. And Walmart in the year 2000 has 1.6 million workers. Now, a lot of these workers are not earning much more than minimum wage. And Walmart, still to this day, as of recording in spring 2020, forbids its workers from unionizing. So, because of the growth of employers like Walmart, who are employing a big chunk of Americans and again not paying a super great rate, by 2000, half of Americans are going to be working for less than $14 an hour. This is driven by a rise in part time employment, which also contributed to a growing number of Americans not covered by insurance because of the tie between insurance coverage and full time employment. And it's also driven by a decline in unions among those lower wage workers.